The past several trading sessions have produced a familiar set of headlines, with silver prices swinging sharply, analysts attributing the movement to speculative positioning, algorithmic trading, or broader macro uncertainty tied to interest rates and currency strength, and policymakers continuing to speak confidently about the resilience of global supply chains. Yet this surface narrative obscures a development that does not fit neatly into any of those explanations and is therefore receiving far less attention than its implications warrant. Beneath the noise of daily price action, Samsung has confirmed key specifications tied to a new generation of solid-state battery technology, and while the public discussion has focused almost exclusively on range, charging speed, and safety, the deeper consequence lies in the material architecture of that battery and the strain it introduces into an already fragile global supply system. By the end of this analysis, it should be clear why this announcement represents more than a technological milestone, why it challenges long-standing assumptions about material availability, and why the question markets have not yet answered is not whether prices will move, but whether the system itself can adapt fast enough. To understand the significance of this development, it is necessary to begin with how the current battery and materials system is generally understood to function. For more than 3 decades, lithium-ion technology has formed the backbone of portable electronics and, more recently, electric vehicles, with steady improvements achieved through incremental chemistry changes and manufacturing scale rather than fundamental redesign. Within this framework, supply chains were constructed around a relatively small set of critical inputs, including lithium, nickel, cobalt, manganese, and graphite, while other metals, such as silver, were treated as secondary components whose usage was dispersed, modest, and therefore manageable. This structure created the impression of stability, reinforced by the belief that higher prices would naturally incentivize new supply, substitution would remain possible, and recycling would eventually close any gaps. These assumptions underpinned policy targets for electrification, corporate investment plans, and long-term forecasts issued by energy agencies, all of which rested on the idea that material constraints would be challenging but not binding. That confidence, however, has been built on conditions that are no longer holding. Mining supply for several key materials has plateaued rather than expanded. Ore grades have continued to decline, and permitting timelines have lengthened across nearly every major producing jurisdiction. Recycling has proven far less responsive than expected, particularly for metals that are used in small quantities across billions of devices, making recovery technically complex and economically unattractive. At the same time, demand growth has accelerated rather than moderated, driven not only by consumer electronics and electric vehicles, but also by large-scale solar deployment and grid infrastructure upgrades. What once appeared to be a balanced system has become increasingly tight, with less tolerance for shocks or unexpected shifts in material intensity. It is within this context of narrowing margins that Samsung's solid-state battery announcement must be evaluated because it directly alters the role of one metal that has historically been treated as peripheral. There is a relevant historical parallel that helps clarify why such shifts are often misunderstood in their early stages. In the late 1990s and early 2000s, tightening emissions regulations forced automakers to redesign catalytic converters, significantly increasing their reliance on palladium, a metal that had previously been overshadowed by platinum. At the time, palladium supply appeared sufficient, demand projections seemed manageable, and confidence remained high that markets would adjust smoothly. As adoption accelerated, however, substitution options proved limited. Supply was constrained by geographic concentration, and inventories dwindled. Governments and industry groups attempted to stabilize the market through stockpile releases and diplomatic engagement, but these measures addressed symptoms rather than causes. Prices rose sharply, volatility increased, and automakers were forced into costly redesigns that took years to implement. The long-term consequence was not merely a price spike, but a reassessment of material criticality that arrived only after significant disruption had already occurred. What made that episode particularly instructive was not the magnitude of the price movement, but the mechanism through which confidence deteriorated. Palladium transitioned from a marginal input to a structurally essential one. Demand became inelastic because regulatory compliance left no alternative, and supply response lagged due to geological and temporal realities. Analysts initially dismissed warning signs because their models assumed linear growth and flexible substitution, assumptions that failed once the system crossed a certain threshold. By the time the constraint was widely acknowledged, corrective actions were reactive, fragmented, and expensive. This pattern has repeated itself in other commodity cycles, from uranium to rare earth elements, each time revealing the same vulnerability. Systems optimized for efficiency rather than resilience struggle when a critical input suddenly becomes indispensable. The dynamics now emerging around advanced battery technology follow a similar trajectory. When systems depend on trust in abundance and adaptability, early stress signals are often reframed as temporary distortions or speculative excess. Market participants focus on inventories and short-term supply data while overlooking changes in underlying material architecture that redefine demand. In this case, the shift lies in the move from liquid electrolyte lithium-ion batteries to solid-state designs that fundamentally alter how ions are managed within the cell. The significance of Samsung's approach is not simply that it promises higher energy density and faster charging, but that it relies on a silver-carbon nanocomposite layer to stabilize lithium deposition and suppress dendrite formation. This transforms silver from a passive conductor into an active electrochemical component, sharply increasing its importance and reducing the scope for substitution. The question, then, is why this moment is materially different from past technology-driven commodity cycles. One critical distinction lies in the absence of buffers that previously absorbed shocks. Strategic stockpiles are thinner, easily accessible, high-grade deposits are largely exhausted, and the timeline for bringing new mines into production has stretched to a decade or more due to regulatory, environmental, and social constraints. At the same time, policy frameworks tied to climate and energy transition goals have hardened demand, effectively locking in consumption targets regardless of price signals. Unlike earlier periods, when demand could be deferred or redesigned without political consequences, today's electrification mandates leave little room for retreat. Compounding these challenges is a fragmented geopolitical landscape in which supply chains are increasingly shaped by security considerations, trade restrictions, and alliance structures, narrowing the range of acceptable sources for critical materials. Silver occupies a particularly sensitive position within this environment. Global mine production has remained relatively flat despite rising industrial demand, and a significant portion of that production comes as a byproduct of other metals, limiting the ability of miners to respond directly to higher silver prices. Recycling rates remain structurally low because silver is dispersed across countless products in quantities that are costly to recover. And when silver is incorporated into long-lived assets such as vehicles or infrastructure, it is effectively removed from the supply pool for years or decades. When a technology increases not just the number of applications, but the amount of silver required per unit, the impact is multiplicative rather than incremental. In such a scenario, conventional market mechanisms struggle to restore balance because the constraint is physical rather than financial. The period in which these pressures are most likely to converge is approaching rapidly. Pilot production lines for solid-state batteries indicate that commercialization timelines are accelerating, and once capital is committed to factories designed around a specific material architecture, flexibility diminishes sharply. Automakers, battery manufacturers, and governments all have incentives to secure supply early, not because of speculative intent, but because the absence of that supply would render multi-billion-dollar investments stranded. As these stakeholders compete for finite resources, market responses are likely to become more reactive, driven by the need to ensure continuity rather than by careful coordination. In such an environment, price becomes less a signal and more a rationing mechanism, reflecting scarcity rather than sentiment. The unresolved tension lies in whether this adjustment will occur gradually through investment and substitution, or abruptly through volatility and intervention. Despite these structural realities, several misconceptions continue to shape public discussion. One common reassurance is that higher prices will inevitably unlock new supply, yet this overlooks the long lead times and declining ore quality that limit responsiveness. Another is the belief that recycling will scale quickly enough to offset demand, ignoring the temporal mismatch between material deployment and recovery, particularly for products with long service lives. There is also a tendency to focus narrowly on lithium, nickel, or cobalt when discussing battery constraints, treating other materials as interchangeable or secondary, even as technological advances make their roles more central and less substitutable. These narratives create a sense of stability that is not matched by underlying resilience, delaying recognition of constraints until options are already limited. At its core, the issue illuminated by Samsung's announcement is not a single breakthrough or a transient market reaction, but a structural shift in how advanced technologies intersect with finite material systems. As silver moves from the margins of industrial use to the center of next-generation energy storage, the assumptions that once supported confidence in supply adequacy begin to erode. This process will not unfold in a straight line, nor will it announce itself neatly through headlines, but its effects will accumulate until they become impossible to ignore. The questions that remain are whether policymakers and market participants will acknowledge this shift early enough to manage it deliberately, and how societies will prioritize access to materials that increasingly determine the feasibility of their technological ambitions. For those seeking to follow these developments as they evolve, rather than after they crystallize into crisis, continued attention to these structural dynamics will be essential, and subscribing for ongoing analysis offers a way to stay informed as the implications of this so-called silver bomb continue to unfold.